What's going on, everybody? Good to see you again. Today, we are going to talk about refinancing. And why we're going to talk about refinancing is, well, you're starting to see the Fed cut rates, and mortgage companies, mortgage loan officers, real estate agents are hopeful that refinancing and lower interest rates are going to be a potential in the next 6 months to a year. We saw a little bit about that during around September-ish, beginning of October, when rates came down. People were actually locking in lower interest rates, and then things shot back up with some of the economic reports. But it does look like we are still on track for rates to come down. So today we are going to talk about refinancing a home, what every homeowner needs to consider. The first thing is, what is a refinance? A lot of people don't even know what a refinance is. A refinance is taking your current mortgage and having a new lender or that current servicer lend you the money to either lower your interest rate or take cash out of that property. So they're going to pay off your current mortgage, and then you're going to get a new mortgage that could, have a lower interest rate. You could even change the term. I highly encourage people, as rates to come down, to actually lower the term of the mortgage. Take it down to like a 15 or a 20 year if possible, if that payment stays relatively close to where you were at, so that you can pay your house off quicker. So a common question is, how does this differ from loan modifications? And loan modifications are really when somebody's struggling and they can't make their payments. They've had a couple late payments. They call their servicer, and their servicer works out some sort of payment plan with them to hopefully help them get on the right track. Refinancing is different. Typically with a refinance, you have to be on time in your payments and things of that nature. So there's a couple different types of refinances that we'll kind of go into. One of them being the rate and term refinance. You have your limited cash out refinance. You have your cash out refinance, your delayed financing, which that's an interesting one that we can get into. Your VA interest rate reduction refinance loan, also known as the VA IRRRL, one of the main reasons why the VA loan is so good, because you can refinance at any time, new appraisal, low fees, the whole nine. And the FHA Streamlined Simple Refinance, which is a really popular program for people that purchased a loan with an FHA loan on their first purchase. So the typical uses are going to be lower monthly payments, improved cash flow, and that's going to be for a rate and term. Another use for a rate and term refinance would be a shortened loan term. So like I mentioned, taking that loan down from a 30-year to a 20-year to a 15-year to try to get things paid off. What a lot of people don't know on mortgages, well, you'll see it when you make your payments on your mortgage, is if you're in a 30-year mortgage, that interest is amortized up front for the most part. So you pay very little principal. So reducing your loan term to, let's say, a 20 or a 15-year, you catch yourself way up. You put yourself 10, 15 years ahead of what you would be paying on every monthly payment. So you can shorten your loan term, pay off your mortgage faster. That's a rate and term. A common use for like a cash out refinance would be home improvements, increased home value. So basically, like, let's say you have a property and it's a little bit outdated and you've had this property for 7 to 8 years. You could take equity out of that property and put it back into your property with upgrades, renovating the kitchen, the bathroom, the rooms, the big stuff. That would help you, raise the value of the property. You're not really going to get much value by taking a bunch of money out and putting in a pool, for instance. But if you're focused on the big ticket items like the kitchen and the things of that nature, you have a good probability that you'll sell your home for more down the line. Debt consolidation. So oftentimes, in a tough economy that we've been in for the last few years, people can get a little bit overwhelmed with credit card debts, payments, and things of that nature. If you have equity in your house, it's a great tool that you can actually pull money out and pay off your debt and lower your mortgage payment if interest rates are low enough. And even if you don't lower your mortgage payment, let's say that you're paying thousands of dollars a month in credit cards, and you can pay off your all those credit cards, you refinance your mortgage, you lower your rate, you increase the loan amount on your mortgage, but overall you're paying out less per month, and it can really help people that are in a financial bind. The last one would be, removing the private mortgage insurance. Now, this one I wouldn't really recommend. The reason why is, if you are at the point where your mortgage insurance can be removed, you can just call the servicer and say, hey, I believe my home is worth enough to, remove the mortgage insurance. And they will actually do an appraisal on it if they feel the need to. Sometimes they'll just remove it. But most of the time they're going to want to do an appraisal, and that's $600 instead of paying the whole cost of a refinance, which is escrow fees, lender fees, the whole nine over again on a conventional loan. So is refinancing worth it? Refinancing can be really beneficial when it reduces your monthly payment, decreases your interest rate, shortens your loan term, or helps you access cash for major expenses like home improvements. So you want to consider things like the upfront cost. For example, if refinancing costs $5,000, but you save $100 a month, it will take 50 months to break even. However, if you're consolidating high interest debt, the interest saved and your overall savings and monthly obligations and interest may benefit you sooner. A lower interest rate could mean significant savings over time. Even a small reduction in rate can result in thousands of dollars and less interest paid. So when we look at a refinance, we want to look, are you going to be moving in 6 months to a year? Because if you're going to be moving right away, it's probably not going to be worth it. It's going to be better to just pay a little bit of a higher monthly payment for that time. Because again, you are going to add in things like prepaid cost. You're going to add in, lender fees, most likely. You're going to add in escrow fees. So you're going to have to pay out of pocket some stuff when you do your refinance. There is one difference on a VA IRRRL, like we mentioned at the beginning, and an FHA Streamline. Those are two very, very low cost refinances. We have borrowers do those refinances with almost no cost, and it ends up making sense for them a lot sooner. But those are only available for FHA and VA loans. Conventional loans, unfortunately, don't have any sort of streamlined refinance right now. On a conventional loan, you almost have to go through the mortgage process again by getting an appraisal and the whole nine. Loan term, refinancing to a shorter loan term, as we mentioned, can help you pay off the mortgage faster, while refinancing to a longer term might lower your monthly payments. So it just really depends. And like I mentioned right here, the future plans, if you plan to sell or move, refinancing may not be worth it. So paying off debt with a refinance pro and cons. The pros would be combining payments into one monthly mortgage, like we mentioned. The cons could be extending the mortgage term and reducing the home equity. So I always tell people if they're in a financial bind, then it may be worth it. It really depends on your situation. Do you have the earning income to pay some of these debts off without pulling equity out of your house, or are you struggling to make it every single month? The key thing is if you are going to do a cash out refinance to pay off debt, it's having a budget plan and a game plan that's going to allow you to not get in the same position again, where you have to refinance again and take equity out again.
When you do a written budget, on paper, on purpose, every dollar has an assignment before the month begins.
A VA cash out refinance allows paying off non-VA debts while meeting VA requirements, offering flexibility for managing high interest debt. So VAs have that little difference that other loans don't have when you're talking about a cash out refinance. Now let's talk a little bit about delayed financing. This is a common refinance that people don't actually know much about. It's not talked about very commonly. All delayed financing is if you purchase a home outright in cash, you can take the equity out of it basically right away by doing a refinance. You don't have to wait the 12-month seasoning period that there is right now typically on conventional and FHA loans. Right now, if you buy a home, let's say with a mortgage, and you want to take equity out or you want to refinance that mortgage or take equity out, you have to wait 12 months. You can do a rate and term refinances, which is what we talked about, where you're just changing your interest rate and the term of your mortgage and things of that nature, but you cannot take equity out for 12 months, whereas a delayed financing, you can take it out right away. So key requirement, the home must be purchased in an arm's length transaction with no mortgage used. So arm's length is like if you are purchasing a home from your brother or your dad or your mom, you're not going to be able to just take the equity out right away. And the new loan can cover the original investment plus closing cost. HELOC, second mortgage, or refinance, what is the difference? So the best way that I can describe a home equity line of credit is like a credit card, in that sense that when you pull out a HELOC on your home, typically it's going to be a second because you're going to have a first. There's enough equity, you pull it out, and you make your monthly payments on the HELOC. Now, if you pay off that HELOC, or let's say you pay down the HELOC, typically the monthly payment is also going to go down on a HELOC, which is a little bit different than if you take equity out of your property. If you do a cash out refinance and you just take all the money up front, Well, now you're in a situation where you're going to be tied to that monthly mortgage payment for the life of that loan until you pay it off. HELOC is a little bit different. So while initial costs are generally lower than the refinance, on HELOCs, the interest rate can fluctuate and there may be ongoing fees, kind of similar, like I mentioned, to a credit card. So second mortgage provides a lump sum with a fixed interest rate, which can be higher than a first mortgage refinance. Upfront costs are typically lower than a full refinance, but the rate is often higher than a first mortgage. So guys, with a HELOC, really a second mortgage is going to also most likely be a HELOC. The interest rate is going to be higher. Whereas if you take equity out of your property, let's say interest rates are low, let's say they're at 4 or 5%, you're going to get a 4 or 5% on that overall mortgage. Where if you're going to take a HELOC, you're going to have maybe a 10 to 12%, maybe 8 to 10, something like that on a second. But here's what we have to look at. How much are you taking out? Because 4 or 5% on a $500,000 loan over 30 years is a lot more than 10% on, let's say, a $40,000, $50,000 HELOC. So that's something that you want to look at. And then cash out refinance, like we mentioned, replaces your entire mortgage with a new one, usually with lower interest rates but higher upfront costs, such as closing fees, because you are going to go through that refinance process again. Now, FHA Streamline and VA IRRRLs, like I mentioned, no appraisal, very low. Those are specifically meant to lower your interest rate. You cannot take equity out with those programs. So a cash out refinance would need an appraisal regardless of doing an FHA, VA, conventional, things of that nature. So what we want to look at when you are doing a refinance is the net tangible benefit. So the net tangible benefit ensures that refinancing provides a clear financial advantage to the borrower. Different agencies, including Fannie Mae, Freddie Mac, conventional loans, FHA, VA, and USDA, require that a refinance improves the borrower's situation in one or more of the following ways: lowering monthly payment for immediate savings, reducing the loan term, switching from an adjustable to a fixed rate, eliminating mortgage insurance, and increasing residual income. That's more specific. Seasoning requirements. So like I mentioned, we talked about that 12-month seasoning rule on a cash out refinance for most cash out refinance. There's also different programs like non-QM programs that you can take equity out sooner than that, but we're talking purely about conventional FHA and VA loans right now. Seasoning requirement: lenders may require that your original loan is seasoned for a specific period of time. This means that they require a loan to have reached a certain maturity and that there's a history of making payments prior to making a new loan. So a seasoning restriction will typically involve who is on title on the current loan versus the new loan, how many months of payments have been made on the original loan, and the type of refinance being used for the new loan. For instance, cash out refinance seasoning is a little bit more restrictive, as I mentioned, than rate and term. So rate and term, you can do it right after 6 payments. Once you've purchased your home, you have to wait 6 payments until you can do the refinance. And I'm going to let you in on a little secret here, but don't go out and do this to any of your loan officers. And loan officers that do this to other loan officers are just the worst in the business, honestly. So the whole reason why you have to wait 6 months to refinance is not because you as a client have an early payoff. It's actually the lender. If you refinance before 6 payments, it hurts the lender. The lender has to pay back, or the loan officer has to pay back their commission that they initially made on the purchase of that transaction, which is why you're going to hear it. Every lender is going to tell you, please don't pay it off before 6 payments, because it's what's considered an early payoff, an EPO. And so it actually doesn't affect you, but don't go out and do that to your loan officer that took care of that. And if you're a loan officer, don't do that to other loan officers. Let's all, as we go into this refinance market, let's do it the right way and wait the full 6 payments. But types of refinance, as I mentioned, the cash out refinance seasoning is a little bit more restrictive.
Guys, I wanted to talk about refinancing because as the feds cut rates and refinancing begins to happen, I want you to understand and have all the tools and look at it to see, is this actually a financial benefit? You're going to have a lot of salespeople just trying to sell you on the fact of buy down all these points, get this lowest rate, things of that nature. We want to look at it from a financial point of view. What is that going to get you in the long run? When you buy down your rate and let's say you roll those costs into your loan, how much of a lower payment is that actually going to give you? So when I do a refinance with a client, we want to do common sense refinancing. We want to break down the numbers, help them understand. I hope this video was informative. We're going to be posting more long form content on refinancing, conventional loans, VA, everything mortgage related. We want to be your go-to source. I appreciate you joining in. And if you can subscribe to the channel, we'd love to see you again.